A 401k is a retirement savings plan offered by many employers. It lets you contribute pre-tax income, which can lower your tax bill. The money grows tax-deferred, meaning you don't pay taxes until retirement. A hardship withdrawal lets you take money out early, but only in certain situations. These situations are defined by the IRS, and you usually need proof. Hardship withdrawals should be a last resort. They come with serious consequences that can impact your financial future. You'll owe income taxes on the withdrawn amount, plus a 10% penalty if you're under 59 and a half. This means taking out $10,000 could cost you $3,500 or more in taxes and penalties. Besides taxes and penalties, you'll miss out on future investment growth. The withdrawn money won't have a chance to compound over time. This can significantly impact your retirement savings, especially if the withdrawal happens early in your career. Before making this decision, explore all other options, such as loans or assistance programs. The IRS sets strict guidelines on what qualifies as a hardship. These typically include situations where you have an immediate and heavy financial need. One common reason is unreimbursed medical expenses for yourself, your spouse, or dependents. This could be for a sudden illness, accident, or ongoing medical treatment. Another qualifying event is the need to prevent eviction or foreclosure on your primary residence. This means you're at risk of losing your home and need funds to cover mortgage payments or rent. You'll likely need documentation to prove the risk of eviction or foreclosure. Funeral expenses for a deceased family member, including a spouse, child, parent, or dependent, can also qualify. This covers costs related to burial or cremation services. You'll need to provide documentation of the expenses. Finally, purchasing a primary residence can sometimes qualify, but it's less common. The rules are complex and vary by plan. Contact your plan administrator to see if you qualify. Each 401k plan has its own process for requesting a hardship withdrawal. Start by contacting your plan administrator. They'll provide the necessary forms and explain the required documentation. Be prepared to provide detailed financial information to prove your hardship. You'll need to demonstrate that you've exhausted all other financial resources. This includes selling assets, taking out loans, or seeking assistance programs. The hardship withdrawal should be your last resort after all other options are exhausted. Once you submit your request, the plan administrator will review it and make a decision. This can take several days or even weeks. If your request is denied, you can usually appeal the decision. However, you'll need strong evidence to support your appeal. Section 4. Weighing the impact, taxes and penalties. Withdrawing from your 401k before retirement has significant tax implications. The withdrawn amount is considered taxable income. This means you'll owe income taxes on it in the year you withdraw the funds. The tax rate depends on your income bracket and filing status. In addition to income taxes, you'll face a 10% early withdrawal penalty if you're under 59 and a half. This penalty applies to the entire amount withdrawn, not just the profit. For example, if you withdraw $10,000, you'll pay a $1,000 penalty plus income taxes on the $10,000. Besides the immediate tax hit, you'll miss out on future investment growth. The withdrawn money won't have a chance to compound over time. This can significantly impact your retirement savings, especially if the withdrawal happens early in your career. Carefully consider the long-term consequences before making this decision. Section 5. Alternatives to consider before tapping your retirement funds. Before resorting to a hardship withdrawal, explore all other options. Start by contacting your creditors to explain your situation. They may be willing to work with you, offering payment plans or temporary forbearance. Consider taking out a personal loan from a bank or credit union. While interest rates can be high, they are generally lower than the combined tax and penalty hit of a hardship withdrawal. Compare rates and terms from multiple lenders to find the best deal. If you're facing a medical hardship, check if your healthcare provider offers payment plans. They may also be able to connect you with financial assistance programs. Explore government assistance programs like unemployment benefits, food stamps, or temporary assistance for needy families. Section 6. Rebuilding your nest egg. Strategies for recovery. After a hardship withdrawal, it's crucial to prioritize rebuilding your retirement savings. Start by creating a realistic budget and sticking to it. Identify areas where you can cut expenses and redirect those funds to your 401k. Consider increasing your contribution rate, even if it's just by a small percentage. Every little bit helps, and over time those small increases can make a big difference. Take advantage of employer matching contributions if offered. It's like getting free money for your retirement. If possible, make additional contributions to your 401k to catch up. This could involve using tax refunds, bonuses, or any unexpected income. Remember, the sooner you start rebuilding, the better off you'll be in the long run.